Good afternoon, everyone, and thank you for coming along to this market update webinar today. I'm Samantha, and I'm part of the energy specialist team, and I'm joined by my colleague Emma from our trading team. So before we get started, if you are having any issues at the moment with your audio, there are some instructions on the screen now that you can look at if you need to change the settings. So, I mean, hopefully if you can hear me, you don't need this, but if you can't hear me, take a read of what's on the slide. Changing the speaker settings does work, or sometimes if you have headphones, plugging them in often helps as well. But if neither of those things work, you can dial in and you can get audio over the phone and still watch the webinar online. At the end of the session today, we will have time to answer some questions, so please use the question function to submit any questions you have throughout the webinar. I'll be collecting these as we go through, and Emma or myself will be able to respond to them at the end. And this session is being recorded, so if you do need to dial off or you're having any technical issues, we'll be distributing a copy of the recording for all customers that have registered today. That will likely be around 2 weeks' time. We'd ask though, when you receive this, it's not shared outside of your organisation. So I'll leave that the slide up for another couple of seconds, just so anyone who's having issues can have a little mess around with them. Okay, so looking at our agenda today, Emma's going to take you through a market update, looking at what's happened since the last webinar, as well as current drivers behind the market movements now. I'll then run you through some CCS updates, and we'll end with some questions and answers. So I will now then hand you off to Emma to take you through the market update.
Thanks, Sam. My name's Emma Williams. I'm one of the energy traders at CCS. And my main responsibility within the team is buying your gas requirements. So in today's webinar, I will largely focus on gas market developments. So since our previous webinar towards the end of last year, there has been quite a shift in prices. This table shows the percentage changes in wholesale gas and electricity prices over this period. The front year contracts, which will start delivery next month, have fallen by as much as 25% since mid-December, with drops of more than 15% in subsequent years as well. If we move on to the next slide, please, we can put these recent reductions in a little more context. This chart shows how prices have moved over the past 3 years for the upcoming annual contract. Over this winter as a whole, prices have dropped by more than 40%. And have now returned to levels that we were seeing before the Russian invasion of Ukraine upended the markets. It's worth noting, however, that even before Ukraine, market prices had been rising due to increased global competition for gas, and that despite the recent significant reductions, current prices do remain above what we'd previously considered a normal range for most of the preceding decade. If we could move on to the next slide, please, this illustrates this point nicely. The red line here shows the current gas price curve. The price curve is the wholesale price for gas out about as far as the market typically trades, so that's about 3 years. The dotted line below is what the price curve looked like a little over 3 years ago. As you can see, 3 years ago, prices were ranging around the 50 pence per therm mark, whilst now the range is closer to around 80 pence per therm. So although markets have fallen a long way from their peaks, a long way from their peaks in 2022, we can see that the overall price environment nonetheless remains stronger than we'd considered normal up until a few years ago. I'll now move on to look into what factors have been at play over the past few months. So first off, demand. Well, demand at home, in Europe, and in competing markets globally has been on the low side. The weather has been an important driver of this. We've had another mild winter. Not only have temperatures on average been well above historic norms, but any colder periods have only been short-lived. It's also been quite windy, and with recent growth in wind capacity across many European countries, This has really reduced the call on gas to meet electricity demand. Aside from the weather curbing demand, we're still seeing underlying reductions in demand as well. Reductions that first started in response to the huge price spikes in 2022. There had been some expectation that with market prices falling, some of this demand destruction might start to unwind, but so far we've not seen much evidence of this. Our team tracks UK gas demand with the implied effects of the weather stripped out. And this analysis shows that UK gas demand, once corrected for the weather, has been almost 10% below the 5-year pre-energy crisis average this winter. And it's a similar story on the other side of the channel as well, possibly helped by the EU's ongoing push for member states to voluntarily target 15% demand gas reductions in order to reduce their reliance on Russian gas. Demand for gas for the power sector has also been lower. As I've already mentioned, strong wind generation has been a factor in this, but improved hydro and higher French nuclear availability have also helped. Wet weather across most of Europe has supported strong hydro generation, and after very poor performance last year, when output was languishing at 30-year lows, this winter has seen considerably more French nuclear generation. This improved electricity supply across Europe, alongside the growing number of physical interconnections between the UK and continental electricity markets, has supported strong imports of electricity to the UK throughout this winter, which has made a significant contribution to meeting the UK's electricity demand, but has also limited the call on gas. Finally, in terms of demand, it's worth casting our eyes further afield to Asia. Demand for gas in key Asian markets, such as South Korea, Japan, and China, has also been relatively muted over the winter, in part also due to relatively benign winter weather conditions there too, but also linked to the lack of growth in most economies. This has limited competition for liquefied natural gas, LNG. This is gas that is supercooled to liquid form for transport by sea. Had there been strong demand for LNG in Asia this winter, prices at home would no doubt have lifted, as Europe would have had to have priced higher to attract the cargoes it required. So now I'll quickly move on to review the supply side. It's thankfully been a pretty uneventful winter. The main sources of supply to the UK have been reasonably stable. Pipeline supplies from the UK, from the North Sea, have been pretty steady, apart from some ongoing niggles at the ageing Barrow field, whilst flows from Norway have also been generally very reliable. There have recently been a few issues impacting Norwegian production, but overall, any unplanned problems have been short-lived and haven't much troubled the market. Deliveries of LNG have dropped off recently, but I'd say this is more a reflection of falling demand than any shortage of supply, and there's certainly been no issues securing cargoes this winter, with the UK mainly seeing imports from the US. Water levels on the Panama Canal have stayed really low this winter due to a lack of rain for some time in that part of the world, and the operators of the canal have therefore had to impose some pretty strict limits on transits. This has supported higher US LNG deliveries into European markets, as producers have shunned taking the longer routes they'd need to take to get cargoes to Asia with these restrictions on the Panama Canal. LNG has also stopped using the Suez Canal since January to avoid the risks of Houthi attacks in the Red Sea. This has resulted in longer journey times for Qatari cargoes, but with most Qatari LNG heading east to Asia instead of west to Europe, this hasn't notably tightened the market. We've also recently been watching developments at Freeport, one of those big US LNG export projects. It had to close down operations at one of its 3 export trains after the big freeze in Texas back in January, and it's still not back online. But just yesterday, we saw an update suggesting that all work should be finished by May, and that following the return to full operations, the overall export capacity would actually increase. So overall, with muted demand and comfortable supply, the call on gas storage this winter has been well below normal. European gas storage stocks are vital to meeting winter demand, and stock levels as we go through the year are the key driver of forward gas prices. This year, stocks are looking as if they are going to end the winter at an all-time high. They have only recently dropped below 60% full, whereas the average for this time of year, looking back over the last 10 years, is 38% full. So these high end of winter stock levels have weighed on prices for the coming summer, as higher stocks means less demand for gas this summer to re-inject into storages. And this has also pushed into pricing for the following winter, what with the market being increasingly confident that tanks will again be full for the beginning of next winter. On the policy front, I'd pick out a couple of key developments over the past couple of months. First off, in the States, President Biden has called a temporary halt to approving new LNG projects, largely on environmental grounds. Crucially, this relates to anything that doesn't already have approval to export to countries. It's just countries with whom the US doesn't have a free trade agreement, but it turns out that's most of the countries that would want to buy LNG from it. So projects that are already in the works and are expected to be operational in the next 2 or 3 years will still be progressing. But it does raise a question mark over what will happen towards the end of the 2020s. There's an expectation that the pause will be just that, and that once the election is out of the way, either Biden would have less incentive to charm the potential Green electorate, or in the event of a Trump victory, particularly given his past statements around oil and gas production, the pause would be quickly reversed. So for now, the market is quite sanguine about this. But should the pause prove lengthy or even permanent, this would have a significant impact on global balances towards the end of the decade. Recent months have also seen more sanctions placed on Russia. Recent US and UK sanctions have targeted Russia's latest LNG export facility, the Arctic LNG 2 project. It is now, having recently commissioned, ready to start delivering, but the sanctions have resulted in buyers issuing force majeure on their contracts, and the project operators are for now really struggling to sell to other buyers perhaps less concerned with the sanctions, due to issues the sanctions have caused in arranging transport. There's also a question mark over the remaining Russian pipeline gas into Europe. Even though pipeline flows into Europe are a mere fraction of pre-conflict levels, there is still about 35 million cubic meters of gas flowing through Ukraine into Europe every day. The transit agreement under which these flows reach Europe ends at the end of this year, and Ukrainian officials have made it abundantly clear that they have no intention of entering into negotiations with Gazprom to renew or extend the agreement. But it is unclear what will happen next year, given that some European companies still have gas supply contracts with Gazprom for gas supplied via this route. And contractually, in the absence of sanctions, they're in a difficult position in terms of reneging on their contracts. So definitely, one to watch. Okay, so back to this summer, with this healthy backdrop of the storage positions, things do look comfortable. But I would say it's worth stressing that, despite this, there still isn't much slack. If the market did have to absorb any kind of significant supply or infrastructure issue, and we do still see periods of quite significant volatility. So that's the extent to which prices are bouncing around, and I think that reflects that underlying fragility despite the current comfortable fundamental picture. So looking forward, the weather, as ever, will be one of the key factors. increasingly over recent years, the summer's been, almost as significant as the winter. A hot summer can significantly lift gas and power demand. It depletes hydro stocks. It affects operation of nuclear plants in France, and hot weather is usually associated with lower wind speeds. So we'll be closely monitoring that. We'll also be keeping a very close eye on progress in refilling storages, obviously, but also looking further afield for any signs of a tightening in the LNG global balance. In particular, signs of any, significant pickup in Chinese demand for LNG. So this has been rather a whistle-stop tour, but I hope it's given you some insight into current market conditions and what the future might hold. Until we hold our next webinar, you can keep abreast of market developments in the monthly purchase updates that we send round. And I will be hanging around at the end of the webinar if anyone has any trading related questions. So on that, I'll hand back to Sam to fill you in on other developments.
Cool, very informative, Emma, thank you. So now I'll just take you through a couple of general CCS updates, things we've been doing recently and things we've got coming up. So firstly then are our billing rates for April delivering strategies. So customers in the L12 and L24 strategies should have received their gas prices on Friday of last week. And the electricity prices are being sent this week. They may have been sent today, but if not, it'll be by the end of the week. All other baskets, so that's your L6, V6, V30, they will be sent a bit later on in April. So it will be before the end of the month of April, but our suppliers will be aiming for sooner than this. Those customers in the variable basket, for your electricity, your reference rates will be sent, and then your usual reconciliations will be applied monthly. And then for gas, you'll get your first sheet with your April confirmed prices on it from Total Energies, and then your normal monthly price change report will be sent by CCS after this. If by the end of April you haven't had your New Year's billing rates, please contact EDF and Total Energies, as they may have been sent out, and it might just be a case of incorrect contact information if there have been any change of staff in your organisation recently. Next, we'll look at Water and Ancillary Services 3 and National Fuels 3 procurements. So these are both underway now, with water currently at the evaluation stage and fuels to begin soon. They're both on target for being awarded in September of this year, and both renewals will still have options for customers to either take part in aggregations or to run your own mini competitions. If you don't use CCS at the moment now for either of these utilities and you're interested in getting more information about them, please let us know. Next, quickly touching on our power purchase agreements. The framework is progressing with legal advice being sought for drafting the terms and conditions. The team actually sent a link out in our latest newsletter to gather some more information from customers on what their requirements are. So if you are interested in using CCS for PPAs, then we would really encourage you to complete this form. I will resend the link out with the slides as well, and the recording from today, so you've got it fresh. But we want to make sure that it's right for you, and obviously to do that we need your input. We need you to tell us what you want. As it stands, it's on for award in early 2025, but do please keep an eye on our newsletters for more updates on where we are with PPAs. Next, we will be launching a bureau service option for customers as a direct award later this year. So it's going to be included as a lot in the new fuels framework, but you don't need to be using the fuels framework now or in the future to access this. You can solely use it just for the bureau services if you wanted to. We don't know yet who that provider will be, as the framework's currently in the tender stage where we are taking submissions. The provider will be offering all of the standard services that you would get from a bureau service, including bill validation and query management. You will be able to pick and choose what you use them for as well. So if you only want bill validation, you would only use that for that service. But if you wanted the full suite, you can pick and choose what things you would want. Again, we ask you to keep an eye on the newsletters for any more information about this. And as it's part of the Fuels Framework Agreement, it is on for the September 24 award. And then lastly from me, all customers currently on supply with CCS will transition to the new RM6251 agreement this April. Suppliers are in the process of sending out their new customer contracts in line with the award, and these are the terms around the physical supply of the energy to you, and they're updated each time a framework renews. So if you do receive a DocuSign envelope from either Total Energies or EDF, this is genuine. Please review and return this when you can. If you aren't able to get this back before the start of April, that's fine, but please do let suppliers know if there will be any significant delays. So they were the updates from me. Next, we'll move on to the questions and answers. So we had a question that was pre-submitted, which Emma is going to pick up for us. Whilst Emma's talking through the first response from this, if there are any questions that you have, please pop them in the box now and we'll be able to pick them up. We did only have one pre-submitted question, so once Emma's finished with that, if there are no other questions that have been sent in, we will draw the webinar to a close. So the question that we'd had then, Emma, is looking at the short, medium and long-term strategies, which is the best performing?
Okay, I suppose it's one of those how long is a piece of string answers a little bit. If we just look at the upcoming delivery year, 2024, it probably won't be any surprise for customers to learn that the baskets which leave most of their purchasing to the near term, so the short-term variable basket, are currently looking as if they're going to be the lowest price baskets. So the V30 basket has been buying already for 30 months. The L6 basket, as we've largely completed purchasing, it's been purchasing over the 6 months. So the L6 basket is about, I think it's about 15% lower in price than the V30 basket, just looking at the energy only. The V6 basket, bearing in mind that we've only bought half of it, and so we're valuing the half that we haven't yet bought at current market prices, which are lower, is about 30% lower than the V30 basket. But I would like to put some context around this answer. Taking 1 year in isolation is always possibly going to give a somewhat partial view of competing strategies. The V30 basket, yes, it is looking, we are expecting it to have slightly higher prices this year than our shorter term locked and variable strategies. However, when we look back over the previous 2 years, both the L6 and the both the short-term strategies had considerably higher prices than the V30 basket, where a sizable amount of the purchasing had taken place prior to some of the madness that we've seen over the past couple of years. So I'd always caution really looking at too narrow a view of basket performance and thinking more about the overall aims of the strategies. But certainly at the moment, with the fact that prices have been consistently falling, for gosh, really since best part of well, certainly for the past year, the baskets that have had most of their purchasing done most recently are looking at lower rates. But all baskets are looking at lower rates for 2024 than were paid in 2023, I think. In fact, I'm going to need to just quickly, I will double check that statement actually before we come to the end, but I'll move on to the next question before I dig out my spreadsheet to double check that, because I've got one question mark over it. So hopefully that answers that question, Sam.
Yep, perfect, thank you. So there's another question that's come in that I can pick up. So how can we check Total Energies or even EDF have our up-to-date contact details? So they both have CCS support teams that we would ask you to get in touch with. I can share their email addresses after the webinar. We would ask you to just email those email addresses that I'm going to send out to you, and just essentially tell them if there's been a change, and equally if there is someone new who's taken over, who that is, or you can just confirm with them what contact information that they have listed to send the prices to. So I think that should answer that one. There's another one that I can answer here also in regards to if you're exiting a site or you're ending the lease, what's the process for letting CCS and EDF know? So the suppliers would be notified directly. We would ask you to complete the forms that they have on their websites. Again, we can share this information with you if it's not something you have, but it would be change of tenancy forms directly with both EDF and TGP. What happens after that point then is once that's been processed and they've received it, they will let us know, so we'll then remove that from our purchasing going forward. Okay, so Emma, next one. I'm not sure if we touched on this really in the presentation anyway, but are the markets back to where they were pre the Russian invasion of Ukraine?
Yes, but as we noted in the webinar, actually markets had already been rising, for the 6-8 months prior to that happening. And so yes, they're back to pre-invasion levels, but no, they're not back to the sort of levels that we were used to in most of the 2010s. And just going back to the price changes from current year to next year for all of our products, the V30 basket is looking at a very slight, I think it's about 4% increase from 23 to 24. All the other baskets are looking at sizable reductions. I can see a question here, which I've been called out. Thanks for the informative update. Are you able to provide a bit more market update on electricity? Yes, and apologies everyone for the focus on gas, mea culpa. Electricity market, I mean, you'll have seen from, all of the charts were showing, and the price table was showing electricity as well. And by and large, electricity prices have been very closely tracking what's happening with gas markets. And certainly at the moment that continues to be the case. The price reductions since the last meeting aren't quite significant as on the gas side, but they're not far behind. The two things that electricity really tracks in terms of its price setting is obviously the gas, but also carbon prices, UK carbon prices in particular. And these have been really weak over the whole winter. I think European and UK carbon prices, and that's really helped electricity prices almost keep up with the movements on the gas side of the fence. UK, why are UK permits so weak? Well, in part, I suppose, I'm sad to say it reflects the sort of lack of demand expected for permits in the UK, linking to the sort of the not great state of our economy at present. Just recently, some of the developments with regards to closures of steelworks and things like that, they were a big purchaser of permits, are weighing on prices. But also the fact that we have got quite a big build out of renewables infrastructure, and it's been pretty flipping windy, so that wind capacity, and growing solar capacity, is being well used. And so obviously thermal generation is one of the big users of carbon permits. So that weakness is also factoring in. I think as well there's just I suppose there's possibly just less of a risk premium being extracted by electricity generators as well. The market is looking increasingly comfortable. I know it's somewhat ironic in many ways. We've left Europe, but we're increasingly interconnected with European electricity markets. I mean, just in the past year, we've seen that capacity increase yet again with, we're now connected to, golly, is it Norway with the Viking interconnector? Forgive me, it might be one of the other Scandinavian countries, but it's a significant additional, I think it's about 1.3 gigawatts of interconnection capacity, and they've got so much hydro electricity in particular that it's typically just in full blast export mode to the UK. So I think electricity markets in terms of the fundamental picture looking quite comfortable. We have got a backdrop of coal retirements, I think, in coal and nuclear retirements actually on the continent, which is potentially going to lead to more volatility in pricing. Germany are retiring lots of coal, some lignite. There's a fair amount of nuclear capacity going offline as well. So a lot less, stable baseloading generation. Far bigger, expanding renewables capacity. So, expect to see a lot more short-term volatility in pricing as a result of that. And I think one of the things we're tracking is, there's quite an uncertain picture looking forwards. I'm sure lots of you will have noticed just recently, was it last week in the news, the government, alongside issuing a second consultation on the review of electricity market arrangements, has flagged that it is now sort of stepping back a little bit in its ambitions to, end reliance on all thermal generation in the UK, and they are supporting further new build for gas because of an acknowledgement that they believe that we're going to need it to sort of provide flexibility to the network going forward. But I think despite that announcement, there is perhaps a little bit of unease about the position later this decade. The massive new UK nuclear site has had its start date pushed further into the future again. I think the latest announcement was that we weren't looking at sort of I think it had already been pushed back to 2029. We're now looking at 2030, maybe 2031 at the earliest. In some of the recent auctions that are there to support the build out of renewable capacity, with really quite steep increases recently in the what would you call it, sort of like the production costs for actually building things like offshore wind farms and even solar. Lots of the sort of big projects have set back from the auctions, and so there is some question mark over, so I think about the 2028 period, that we could maybe looking at a little bit of a sort of capacity gap. But that's a long way off. So anyway, hopefully I'm sorry, I've whittled on for ages about electricity. Apologies for those that were hoping to hear more about electricity. But next time we do a webinar, I suspect it will be my colleague Tom who does it, and he can give you a far more comprehensive and knowledgeable roundup on electricity market developments. Right, is there any more trading questions?
Well, yeah, there's one more trading question. So, well, there's two, but they're the same. So you can pick this one up, and then there's a couple more for me. So it's two questions that have come in, and they're pretty similar. It's basically asking if we anticipate the prices dropping any further, or is this the new normal?
Well, you know what? I mean, I don't know if you remember that third slide that showed the price curve. If you think back to that slide, you could see that certainly the market expectation is that prices for the next 2 to 3 years are all quite similar. The near term has fallen with it having been such a sort of comfortable winter, and now 2025 and 26 are at a slight premium for gas, and in part that's due to the fact that there isn't expected in the next sort of 2 years to be a huge expansion in terms of sort of global gas production. And sorry, I'm back to talking about gas here, but stick to what you know, Ray. There is, however, from the middle of really from 2026 onwards, we are expecting a really quite significant build out in global LNG production capacity. I didn't mention it in the slides and possibly should have, but whilst the US, they've got huge plans for building out more LNG later into the 2020s, and yes, there is this pause on, that's putting some of this in question at present. But I think there is a widespread expectation that one way or another, they like making money at the end of the day. You know, what are they calling it? Trump was calling it their freedom gas, wasn't he? So, you know, I think there's a widespread expectation that it will prove to be only temporary, and we will, you know, on top of the pretty big build out in US capacity that's already baked in from sort of, you know, big time from sort of 2026 onwards, there is a massive expansion in Qatari capacity. And not long after Biden announced this pause on permitting, I think literally about 10 days later, the Qataris came out and announced a third massive expansion. So they're already planning on, I'd already got 2 expansions planned starting in 2026, but they've now announced a third one, which would mean that by 2030, we'd be looking at Qatari production, which is already massive, being 85% greater than it is at present. So all things being equal, if we didn't have a sort of corresponding increase in demand, which is quite a big ask because it is such a big increase in production capacity, I think we do have some expectation that in the latter half of the decade, you know, we'd expect gas prices to moderate, and that, you know, that would, you know, probably take electricity prices with them, because we do expect, certainly in that time horizon, that electricity prices will retain their linkage with gas markets. So I think, you know, given what we know in terms of, you know, projects that are coming online, expected demand growth, and obviously that's really hard to predict. You know, so much of it depends on sort of, you know, whether we ever see any kind of return to sort of, you know, a more positive global economy. But some of it's also price sensitive. So I think on balance, we do expect some retracement later in the decade, but certainly for the next couple of years, you know, we can see that prices certainly ahead of time retaining some sort of premium. You know, we'd be in a very different place right now if this winter hadn't been really mild everywhere. And, you know, that's why we're looking at prices for 24 and 25 that are, you know, slightly above near-term prices, because, you know, obviously it's way too early to know what kind of, you know, weather-related demand we're going to see in those winters. Anyway, that's my view. As the rest of the team will probably tell you, I'm almost famous for being wrong, so I certainly wouldn't quote me, but that's where I'm pinning my money. Any more?
So there are a couple more, but they're a bit more operational, so I'll pick them up. Firstly, can we add an additional supply point to the TGP supply? So you can do this, but it won't go into the April 2024 pricing because that's already almost fully complete. So if you added a new site now, or any time up to, I think it's the 15th of September, if you're in an April delivering strategy, it will go into the April 2025 basket. If it needs a contract price before then, it would have an interim rate, which is priced at the market conditions at the point in time in which the supplier is essentially receiving your site edition template. So yes, you can add a site now, but it won't go in the basket until April 2025. Next is a customer who said they'd received their total energy rates earlier this week. When will they see EDF? So I did cover this off in my update. EDF will be sent this before the end of this week. So we know TGPs have all been sent and EDFs are slated for the end of this week, but that is just for the L12 and the L24 strategies. Everything else will be sent before the end of April. And then lastly, who will the DocuSign from the suppliers be sent to? So it will be sent to whoever the named contact is that the supplier has for your organization, and you can check who that is by contacting the suppliers. Again, I'll give you those email addresses for contacting the suppliers when we send out the recording for the webinar. So I'll probably call it a day there now, Emma, because we're close to Q2. So just like to thank everyone for taking the time today and coming along to the webinar. If you do need to get in touch with us, you can email us. Our email address is info@crowncommercial.gov.uk, or you can call our service desk at 0345 410 2222. Thanks again, and we'll be sending the webinar out, and we hope you found today useful. Thanks, everyone.